Okay, before we start, I want to thank everybody for joining this webinar. We want to thank our sponsor for this webinar, Hockman Salkin Tosha Perez PC. They're sponsors of the taxation law section. They're one of the preeminent tax law firms in the United States by attracting highly respected nationally and internationally recognized tax lawyers to their ranks, taxlitigator.com. And if you're ready, Bill, you can start.
I'm ready, thank you. Well, welcome to this second webinar in this series that the Beverly Hills Bar Tax Section is doing on the international provisions of the Tax Cuts and Jobs Act. We're doing the final regulations. We've had one session already on GILTI earlier in the year, and this one is on the new final regulations of the foreign derived intangible income, FDII, and the high tax foreign, also high tax GILTI exception, and proposed high tax regulations on the high tax exception under the subpart F provisions. Our panelists today joining me, Paulina Shapiro, between Hansen and Jags. She's a partner in the CPA firm here in town. And also Brian Kelly at Withers Bergman, who's in Century City, who's an attorney. And together we're going to cover these three topics. First, going to start off with, I'll start off with a discussion of the overview of the FDII regulations, some of the mechanics or calculations, and then do an example or two and talk about some illustrations. And then Brian's going to help us with the new or revised substantiation rules on how you qualify for this FDII deduction, which we'll talk about in a moment. And then we'll turn to Paulina, who will take us through the high tax exception to the GILTI inclusion provisions, and and talk about the proposed regulations for the high tax exception under subpart F. Let me just move here to first topic. I've got just a slide on the effective dates for the FDII final regulations, as well as the GILTI provisions themselves. This is the statutory definition for tax years beginning after 12/31/17. So basically, a calendar year 218. All right, so here we have the effective dates of the FDII regulations. We have various effective dates here. The final regulations, which we're dealing with, the taxable years beginning after January 1, 2021. So we've got some time. There's an election if taxpayers want to use the final regulations in their entirety for years before, beginning before January 1, 2021. And then you can use reasonable methods, if you will, or interpretation of the statute for years before, that begin before January 1, 2021, or even the proposed regulations with certain changes relating to substantiation. So let's take a look at what we're talking about here. This particular deduction, the foreign derived intangible income deduction, relates only to a domestic C corporation. And also the GILTI deduction, which we'll talk about later, is also available only to a domestic C corporation, except for a special election for individuals. So basically, the deduction is a sum of two items, 37.5% of something we call foreign derived intangible income. It's a defined term, which generally ends up with an effective rate around 13 and an eighth, and 50% of the GILTI inclusion, plus the any gross up if you're talking about a C corporation, which we are here, which generally gets you to an effective rate about 10.5%. Those particular percentages get reduced for years beginning after 2025 It's indicated at the bottom of the slide. There is a taxable income limitation, which relates to these two deductions. And you take the two bases, if you will, FDII, which we'll talk about as the definition of that, and GILTI, and together those two can't exceed the taxable income of a domestic corporation. This is claiming deduction. There are then some rules that, which we'll talk about as to how you allocate, if you will, the excess, and they're in the slides. This is just the formulas for the reduction. In other words, if you have excess deduction, you got to reduce excess sum of the deductions, you have to reduce the two, and that's what this formula does. We won't spend any time on it. This then is this important definition, which is this deemed and this foreign derived intangible income. What is it? Well, it's something we call deemed intangible income times a fraction. And all of these items are that are in this formula are defined, and I have a slide which I'll bring down right now, which is an attempt to put in one slide these various equations and definitions. So on the far left, you can see foreign derived intangible income, or FDII. That's the tax base, if you will, or deduction base in which you multiply that particular fraction we talked about, the 37.5%. And that equals then a product, which is on the middle and the right-hand side here, something called deemed intangible income. And below it, I have put together the definition of that, which if you follow it down there in orange, you see the deduction eligible income, which then is just the gross income of the domestic corporation with certain exclusions, which are listed there. So essentially, it's the operating income of the domestic corporation. And then from that operating income, and it's net, by the way, deductions are allocated against it, you subtract something called deemed tangible income return. And what is that? Well, that's 10% of something we call qualified business investment, which are basically the adjusted basis of the tangible assets that are attributable to this kind of income we're talking about, averaged over the quarter, each quarter for the year. So then you've got then at the top there in the blue, in the middle, deemed intangible income, and you multiply it times the fraction. The fraction is then essentially allocating this kind of operating income minus this return on tangible assets between domestic and foreign. So on the top there is foreign deduction eligible income, which is what we just talked about previously, but it's only the foreign side of it. And below that, below the heavy line there, is the total of all deduction eligible income. And then that gets you a fraction that you can then multiply times your the intangible income that's in excess of your return on tangible asset. Now, the names of all of these particular types of income are not really completely accurate. The idea is that you're supposed to come up with a return on intangible income from these foreign transactions, essentially export transactions that Brian will talk about. And you do that by subtracting out this return on your tangible assets, a 10% return, which is just an arbitrary number. So it's not truly intangible income that we're looking at, but it's the names that we've given in the title here. All right, so let's just move along here. Here is this deemed tangible income return that we talked about in just one slide. It's 10% of what we call this qualified business investment. And then further, here you can see what the tangible property is. It's property used in the trade or business by the domestic corporation, for which the deduction is allowed under this alternative depreciation system, which is slower than the normal depreciation you would take. If we just go back a moment to this slide, what would you actually be trying to do here in terms of planning? The idea is to maximize the foreign deemed intangible income that's over there on the far left. And you can do that by making the blue box in the middle bigger. And how do you do that? Well, you reduce the deduction against the otherwise deduction eligible income. There's some anti-avoidance rules that are in the slides we'll talk about. But to the extent you have less tangible income, 10% of that's going to be a lesser number. It'll result in a bigger deemed intangible income. And this will be multiplied times your fraction that's over on the far right. You want that fraction as big as possible. Obviously, you make the numerator, which is the foreign derived deduction eligible income, as big as possible, which requires both having transactions that qualify for that category and also doing substantiation that Brian will talk about. What I've done here on these slides is to reduce these calculations into a series of equations, which I'm not going to go through, but just to give you some idea of how they're put together, and I'll skip over these. So here I put together an example of how this all works. This is from the regulations. We've got a domestic corporation, DC. It's not a member of a consolidated group because that adds other complications. And we've got sales and services not to related parties, again, to simplify some things. And we have all of the sales and services to foreign persons that qualify as these foreign derived deduction eligible income transactions, which is what we need to qualify. So let me move along here. And these are some more facts. Here, this domestic corporation sells products A and B in the US, sells products also to overseas as well. We've got a business interest deduction. We've got business assets here that we need for this calculation. And we've got supportive deductions. This is more facts in this particular situation. There's the three products you can see here. Row one is the gross receipts from these various products. One is the domestic, two is foreign, three is the total, and we have the cost of goods sold. That's the inventory cost, if you will, for these two types of transactions, and 4 and 5. Total, you can see the gross income. So the first thing here is to determine gross foreign derived deduction eligible income and the part that isn't, because there's supposed to be the allocation of expenses. So the domestic corporation has no gross income that's excluded from this domestic eligible income, and there are no excluded items of gross income. So we have to worry about that. Next one here. So we've got then to do this gross domestic eligible income, or DI, if you will. We've got the 2200 from the prior slide, the one that has all the grids. Subtract the expenses, supportive expenses, and the inventory costs. You get the 1600, and then from that you look at what the foreign person's amount of this gross FDII is, which is 1100 minus the 300, the inventory cost. We get the 800. Then we go to the next one. And so now we want to apportion the interest expense, which is the $300, to the foreign DDEI. We've done it by a gross basis here, the 1250 over the 2500, and we get $150. Then we want to apportion the supportive expenses. And we can see here that was $840. And so we have to have a little fraction here, which is we do it by gross income. So we take the 1,600, which is the total of our gross income, we subtract out the domestic piece of it, and put in the denominator the worldwide piece, if you will. We get the 420, and then the PAD, which is the properly attributable deductions, is then the interest expense of 150 plus the 420 that we just calculated here for 570, and then now we can get the foreign derived deduction eligible income, which is 800 minus deductions here, and we get the 230. And now we have to do this domestic intangible income calculation, which is the gross amount of all of this domestic eligible income. Subtract out the interest and subtract out the supportive expenses, we get the 460. And then we have to come down to how do we get the return on our QBI, and that's just the 10% of the 1,000, which is for our facts. And now we've got the 460, which we just calculated, subtract out this return on intangibles, and we get 360. And so now the final, almost the final calculation here, the foreign derived intangible income is now this domestic eligible income, tangible income, I'm sorry, times this ratio we just did. So it's going to be the 230 over 430, which is a half, times the amount of DII, which is 180. And 180 is what we then multiply to get our the amount of the deduction. So that's kind of the mechanics of how it works. I wanted to move to yet another slide here. If I can get to it. 93. Okay. All right, so this is a set of illustrations. And what I did here, and we won't go through them, but what I did is I went through and I put together a series of illustrations. One where we had a C corporation that claimed the FDII deduction. One where we used an S corporation that used the 199A deduction, this qualified business deduction that's only available to individuals and pass-throughs. And then a C corporation with a foreign sub that had subpart F and GILTI. And then I came out with these various effective rates based on these facts. And when you look at planning a situation, should you try to use the FDII deduction, the FDII deduction, or should you just forget that and use a pass-through if you're not a publicly held company, or don't have multiple shareholders? Or should you go overseas or remain overseas? And when you ask this kind of question, attorneys typically say, well, it depends. And accountants say you have to model it. And so this is an attempt to do a little modeling. The fact pattern that I put together here is one where we've got a U.S. individuals at the top. There's a U.S. corporation, which then varies whether it's a C or an S corporation. It has a foreign subsidiary, Forco, and you can see it has sales to U.S. customers. It's got licensing to the foreign company. The foreign company does some assembly or manufacturing. The U.S. company does some service transactions. These are all in dotted lines. And there's also sales to an unrelated distributor. And so this is the basic fact pattern I use. You can see the numbers. And then I worked out using the FDII deduction, the 199A deduction, and finally just using a foreign subsidiary that's subject to GILTI and Subpart F. So let me move on to another one here. I want to go to slide 127 if I can. Okay. So here's another situation of what I call modeling. What I did here is set together a series of alternative structures, which I'll turn to one in a minute, and then computed what the tax would be, the tax burden at the corporate level, if it's other than a pass-through, or what would be the ultimate tax shareholder tax burden at that shareholder level, if either it was a C corporation that passed it on up to its owners, or it was a pass-through that went directly, if you will, from a tax viewpoint to the owner, ultimate owner. The assumptions I used here, I was trying to take something other than the kind of maximum rates. So I took a California income tax rate of about 11%. Then I took a federal dividend rate, 23.8, which is the maximum. These are the maximum rate. And then a federal personal income tax rate of about 31. So I was trying to model something around a $500,000 annual income. So that was the idea of it. Let me show you one of the structures here if I can get back to it. So here's just one of the structures. So you got an individual that owns a C Corp that has foreign customers, and there is no FDII deduction. So this is what happens without any of these provisions that we're talking about today. So you can see at the top, there's a California corporate tax, and there's a federal tax on the difference between the income before the California tax and afterwards. And then there's a distribution, and we've got a California dividend tax, and we've got a federal dividend tax. I did not offset the California dividend tax against the federal dividend tax. So you see this 53% effective rate. And then you can go to an S corporation. This is a flow through, again, not using any of the provisions that we've been talking about today, or we'll be talking about today. You can see you get a 43% effective rate. And then we'll move down to pick up another one here. This has an IC disk. This essentially allows 50% of the export net income of the S corporation or individual investors back not to be taxed currently, and then there's a distribution that gets the qualified dividend rate. You can see a rate of 39.49 there. And then here we one more down here. And here you can see one with the 199A deduction. We get the rate down to 39%, or almost 40%. And then one more here. Here we've got the 250 deduction for the C corporation. And you can see at the corporate level, in this particular pattern with the California tax, we're getting 20.8%. Not the lowest possible way you could get, because you're adding California tax in there as well. And if it's a distribution all the way out, it's down to 48. So that's just some examples of how you might look at these various provisions in a series of alternative fact patterns, to the extent these are relevant alternatives for a particular client situation. So with that, let me turn it to Brian.
So I'm going to pick up where Bill left off here. And just to kind of set the stage, you know, Bill took us through the computation. And here we're going to drill down a little bit on sort of what is in a sense the most important piece of the computation, which is your foreign derived deduction eligible income. Without that, you don't have FDII, or at a minimum, you can't compute it. So the statute and the regulations distinguish between sales transactions and services transactions for this purpose. And on the one hand, you have a sale, lease, license, or other disposition of property, which we'll refer to as an FDII sale, or a provision of services, which we'll refer to as an FDII service. I'll go through sales and services separately, but sort of a few overarching points to start. The final regulations are very different from the proposed regulations in terms of what needs to be done in order to substantiate a claim that one has FDII and therefore is entitled to take an FDII deduction of some size. For people who had followed prior chapters of this whole saga, the proposed regulations included specific documentation requirements that were needed to establish the key requirements for having FDII sales or services. And if you didn't meet the documentation requirements, you didn't qualify to take the deduction. The final regulations peel that back in two ways. One, they move away from a requirement to have specific types of documentation, and they replace that with substantiation requirements, which are intended to be more flexible and which focus on sort of the nature of the information that's required rather than specific documents. So it's sort of a move away from, gee, can we get a passport from this person, or do we have a sales agreement that has particular elements in it. The other way that it moves the needle a bit is that the specific substantiation requirements only apply to certain FDII sales and FDII services transactions. And if there aren't specifically applicable substantiation requirements, then taxpayers are subject to the substantiation rules under 6001. So basically required to keep a file that has sufficient information in it to establish eligibility for the deduction. The additional parameters that the FDII rules put around that are that substantiating documents where they're required need to be in existence by the FDII filing date, which is the date that the tax return claiming the benefit, including extensions, is due. And if the IRS asks for substantiating documents, that those have to be provided by within 30 days or other agreed period. A couple of other items. There is a small business exception for taxpayers and related parties with aggregate gross receipts of $25 million or less during the prior taxable year. That's, again, for people who have followed the saga, there was an analogous exception in the proposed regulations, which was set at a $10 million gross receipts level. They raised it to 25, but they expanded the testing pool from the taxpayer to the taxpayer and its related parties, so that this may be a win for some and a loss for others. Another mentionable is an anti-abuse rule for loss transactions. And I think I saw a question in the comment box on whether you could choose to take this deduction or not. And the preamble, I think people have asked that question, and the preamble and the regulations do not address it specifically. So I suppose that you would answer that question with respect to general principles. But the one thing that the regulations do address is cherry picking. So they do have a concern that people might look at a series of transactions and take the loss transactions and say, well, look, you know, if I didn't have substantiation for this, this wouldn't be an FDII sale or service transaction. So I just won't do the substantiation, and I will drop the loss transaction out, which will increase my FDII and my deduction. And the solution to that is that gross income from those transactions is deemed to be FDII if the seller knows or has reason to know that it qualifies, that it's a sale to a foreign person for a foreign use, or that it's a service that's rendered with respect to a person or with respect to property that's located outside the U.S., and not treating the transaction or transactions in question as FDII sales or services transactions would increase the amount of FDII. So that's one thing that they did speak to specifically. A couple other preliminaries. There are questions that do come up in some fact patterns around whether you're dealing with a sale or a service, where you have engineering, procurement, and construction companies that will fabricate and install, a turbine or something like that. And there's sort of a blurry line between whether they're selling property or providing a service, or a little bit of both. The regulations loop in existing authority on predominant character. So referring back to some authorities that basically would resolve that question by asking what the predominant character of the transaction is, whether it's sales or services. The other sort of overarching item to mention is partnerships. So the drafters made a decision to treat partnerships as separate entities for purposes of determining whether income constitutes DEI or FDEI. So a partnership itself can be a seller or a service provider. It can also be a recipient of goods or services, and it can be a related party as well, when we talk about the related party rules. So a couple of examples here. I won't go through these in excruciating detail because I'm mindful of time, but the first one shows a situation where Domestic Corp DC, who's a partner in a partnership, is selling inventory to the partnership. Example one, partnership is a foreign partnership. DC sells inventory for 10 million, recognizing gain of 2. Partnership through its foreign branch resells for 11, so there's another $1 million of profit. So in that circumstance, DC's gain from the sale of the partnership is both DEI and FDDEI because it's a foreign partnership, and there's no look through. The partnership is sort of they've taken an entity approach there. The partnership's income in that example is not DEI or FDDEI because it's a sale through a foreign branch, and sales through foreign branches are excluded from DEI. And you can contrast that with the situation where the partnership is domestic. So, the sales of the partnership is not an FDDEI sale. It still produces DEI, so it increases your denominator, but not your numerator. And the $1 million of gain from the resale by the partnership to foreign customers may be DEI and FDII if it satisfies all the requisite requirements, and DC's distributive share of that could be included in determining DC's FDII or FDII deduction. So with that overview, let me toggle over and talk specifically about sales. So as I've alluded to, and I think Bill may have alluded to it, an FDII sale is a sale of either general property or intangible property to a recipient that is a foreign person for a foreign use. And we'll unpack how you make the determination whether a recipient's a foreign person and how you make a foreign use determination, which depends on the type of property that's being sold and the characteristics of the transaction. This slide is largely definitional, but the one definition that I would focus people's attention on is end user. The regulations differentiate between somebody who's a recipient, that's the foreign person who receives the property or the services from the seller or service provider. That recipient may or may not be the end user, which is generally the person that ultimately uses the property or consumes the property or acquires it in a foreign retail sale. And that's important because, you know, as you'll see, the way that these rules apply, the identity and location of the end user becomes important in a number of cases. So we can talk first about foreign person. And here, you know, the final regs provide a set of presumption rules. The proposed regs required you in most instances to make a determination based on documentation and to keep a file with documentation. Final regs will presume a person to be a foreign person. One, just generally, if the sale is a foreign retail sale. Two, if the property is delivered to the recipient or end user and the shipping address is outside the US. Or otherwise, with respect to general property, billing address of the recipient is outside the US. Same for intangibles. If billing address is outside the US, you can presume foreign person status. Now, there are that presumption doesn't apply if the seller has knows or has reason to know that the recipient is not a foreign person. And folks had asked for examples of what sort of information might cause a person to be charged with that knowledge, and the regulations were sort of very specific about, well, they provided an illustrative, not an exclusive, all-inclusive list, but it's sort of things you would think about if these crop up during the ordinary course, that they're indicia of U.S. presence, a U.S. phone number, billing address, or shipping address, or in the case of an entity, evidence that if it's it's incorporated, managed, or formed in the U.S. So flipping over to talk about foreign use. As I had mentioned, foreign use is determined differently depending upon the type of property. So question one is, what's general property? And it's defined by exclusion. It's any property other than intangible property, which we'll talk about, a security, a commodity, or an interest in a partnership, trust, or estate. And I'll pause on that fourth bullet there, referencing partnership, trust, or estate, because that was in addition to the final regs that didn't get a lot of attention, but it seems to me there's some incongruity there, because the final regulations do also tell you that if you sell a disregarded entity, they'll look through, and to the extent that a sale of any of the underlying property might produce FDII, you'll benefit from that. So I kind of look at the world and I say, gee, well, if I sell a disregarded entity, I might be able to generate FDII. If I have an interest in a partnership that sells property, I might be able to generate FDII. But if I sell an interest in that partnership, I clearly can't. So there's a little bit of incongruity there. Couple of other mentionables. They did carving out from the carve out, if you will, physical commodities that are described in 475E2A, which I believe is actively traded commodities, if they're physically settled. And they did express in several places that general property includes sales of digital content. So that example 7 that I referenced in the slide there deals with downloadable music that you buy over the internet. So foreign use, in the foreign use space, the final regs do identify 6 different types of end users and provide separate rules for property subject to manufacture. For sales to end users, slide 14, I won't go through all of these, but they've sort of identified 6 different types of sales to end users, and they've indicated in what circumstance foreign use is established. And the 2 that I'll flag for you are sales for resale, because unlike the other 5 types of sales to end users on this list, that does require specific substantiation. So you've got to establish that the general property will ultimately be sold to users outside the US, and you've got to comply with the specific substantiation rules to do that. The other item that I'll flag is sales of digital content. So foreign use is established if the end user downloads, receives, installs, or accesses that purchase content on the end user's device outside the US. So that's the general rule. They're focusing on where the user is accessing or receiving the content. There's a backup rule that indicates that if the information is unavailable and the gross receipts from all sales to that end user for the year are under $50,000, you can use their billing address in lieu of the primary rule. So, as I mentioned, manufacturing is dealt with separately. So, sale of general properties for foreign use, if it's sold to a foreign unrelated party that subjects it to manufacture, assembly, or other processing. And the regulations go into some level of detail around what constitutes manufacturing. So they have 2 ways to get there. One is the property is subject to physical and material change, and the other is that it's incorporated as a product, as a component of another product by activities that are considered substantial in nature and that would generally constitute manufacture. There's also a safe harbor for that component test, where if the general property has fair market value when it's delivered to the recipient, that's no more than 20% of the fair market value of the finished good, then it's considered to be incorporated as a component of another product. Those rules, by the way, are I believe that the preamble sort of disavows any relationship between those and the manufacturing rules under Section 954, but they are really quite similar. So I want to talk a little bit about substantiation, and I'll spend more time on it here and less time on it later, because where substantiation is required, the way that the regulations frame the exercise is pretty similar in all of these different contexts. So in the context of sales for resale, here's what they tell you. You have to have one or more of the following. You got to have a binding contract that specifically limits subsequent sales to sales outside the U.S., which either you have or you don't. Proof that the property is specifically designed, labeled, or adapted for foreign use. So, if you're manufacturing cars and the steering wheel's on the right-hand side, you have an argument, just as an example. Proof that cost of shipping the property back to the U.S. would make it impractical to do so. Or credible evidence that's obtained in the ordinary course of business, evidencing that the property will be sold to an end user outside the U.S. So that might be information that your counterparty provides you as part of the process of negotiating an agreement or in subsequent correspondence. And the last option they give you is a written statement corroborated by evidence that provides detailed information on the transaction. And in the context of a resale, they tell you that it needs to include a description of how the taxpayer determined that the property will ultimately be sold to an end user. And that really is the paradigm that they lay out for all of these areas or instances in which specific substantiation is required. And I have two observations on this. One, there's a little bit of overlap between what's in these different bullet points. The written statement seems to absorb a lot of what they would be asking for in some of these other bullet points. And my other observation is that I think on the one hand, you can be practical about this, because there are certainly situations where you or your client will have a lot of this information and be able to feel comfortable that if you were requested for documentation, you'd have an audit ready file. The other point I would make is the rules, I think, are intentionally vague about how you satisfy these requirements. And there are a couple of examples in the context of resales and manufacturing that explain how these rules might apply, but they're pretty limited in terms of the utility, because they address what look to me like obvious fact patterns, where in one of them you have a seller with invoices that limit resales to end users outside the U.S., and the taxpayer has prepared a written statement. So it's really a belt and suspenders situation. And that may be the way that people want to approach it, is to just start with what you have and then, try and build it up a little bit and hit as many of those bullets as you can just to make it open and shut, obviously taking into account cost benefit on that exercise. So that's general property. Let's talk about intangible property. And I'll start with what it is for these purposes. It's defined by reference to 367 D4, which includes a litany of different items, and a catch-all that tells you it includes really any item, the value of which isn't attributable to either tangible property or the services of an individual. So it's broadly drawn, and it does include most of the things that you would think would be included. They did go out of their way to carve out copyrighted articles like that downloaded music that we talked about, because they're intended to be covered as general property rather than intangible. So if you're in the IP category, substantiation requirements apply to all of your transactions. And the rules differentiate between periodic and lump sum payments. And so if you've sold or licensed IP rights for periodic payments, then the extent of your of foreign use is determined on an annual basis, based on primarily actual revenue. And if actual revenue can't be obtained after reasonable efforts, then there are provisions for estimated revenue to be used. The lump sum rules would have you, the seller or licensor, make a foreign use determination based on the ratio of the net present value that's reasonably expected from foreign use of the property to the net present value of the total revenue expected from the property. And the rules do specifically indicate that they'll be testing the reliability of your inputs. And if this is a third-party transaction, then I think what they're really saying is they probably expect you to be using the same projections and inputs that you used in determining the sales price to do this computation. And if you're using something very different, you're bound to get questions on that. And if it's a related party transaction, then the reliability of the inputs has to be determined under 42 principles. And I will mention that these periodic and lump sum rules that I've talked don't apply to IP that consists of a manufacturing method or process. And the reason for that is that if the IP is a manufacturing method or process, they treat your recipient as the end user. If otherwise, they look through to an ultimate end user, and who that end user is and where they are depends on the type of transaction or the use of that IP by the buyer or licensee. So if the IP, for instance, is embedded in connection with the sale of general property, then you're looking at who the end user of general property is. If it's used to provide a service, it's the end user is the service recipient. If it's a manufacturing method or process, as I mentioned, it's going to be the foreign unrelated party that you've transferred the rights to. And lastly, and I'll flag this one for future discussion, if the IP is used in R&D, then and it effectively is used to develop new IP, then the end user is the user of the secondary IP. And there's an example that we'll look at on a minute in terms of what that means and sort of the view that Treasury takes on it, because it's an interesting point. So these are, I've laid out here on slide 19 the substantiation rules for these types of transactions. That you'll notice that they are very similar in terms of the way they approach substantiation. It's obviously fact-based, so the things that they're asking for are geared to sales and licenses of IP rather than general property, but it's the same concept. Okay, so this is the example that I mentioned. They were pretty generous with examples on foreign use of intangibles. There are 13 of them, and if you read all the way through to 13, you'll get to this one. And it's gotten a lot of attention because I think it surprised folks a little bit. And I won't go through line by line, but sort of the high level on this is that you have DC license IP to FP, which FP uses for R&D purposes. And FP is paying a royalty of 100x starting in year 1. It isn't until year 5 that FP actually begins to generate revenue from secondary IP. And in this case, they basically created a new vertical off of this patent to treat a new disease, and they've begun to generate revenue in the market on that vertical. The surprising part is in years 1 through 4, DC gets no benefit. There's no secondary, there's no revenue generated through secondary IP or benefit provided to customers off of secondary IP. So they take the position that there's no foreign use and therefore no FDII. That's, a little surprising and a little bit incongruous with how, a general property transaction would be treated. In a general property transaction, you might be looking, if FP were a manufacturer, let's say, and using the property to manufacture, it might not matter whether they generate revenue in year one or year two. So it's a little different than what some people maybe expected and worth being aware of. Okay. So with that, I'm going to toggle over and talk a little bit about services. So services are treated as FDII services to the extent that they're performed with respect to a recipient or with respect to property that is located outside the United States. So that's the key with services, is your recipient or is the property with respect to which you're performing services located outside the US. Final regs, like the proposed regs, deal with this by subcategorizing services into 5 different categories. So you've got general services provided to consumers, general services provided to business recipients, proximate services, property services, and transportation services. And we'll talk about all of those in turn. But I should note before I toggle off of this slide that the final regs did also, interestingly, add 2 new subcategories of general services. One is advertising services, and they define that to mean services that primarily consist of transmitting and displaying content to consumers with a purpose to generate revenue based on the promotion of a product or service. So ad services, either over the internet or otherwise. And the second subcategory is electronically supplied services, which are meant to include things like streaming of content, that is without the downloads, and software as a service type services that might be provided. And the rules, of course, for determining the location of the recipient or the property depends on the type of transaction. So we'll kind of go transaction by transaction. So general service, like general property, is defined by exclusion. It's anything other than a proximate service, a property service, or a transportation service. Consumer is an individual recipient that purchases general services for personal use, and a consumer is generally considered to be resident, to be located at the place of their residence at the time the service is provided. And if you can't make that determination after reasonable efforts, you, the service provider, can use the consumer's billing address, again, unless you know or have reason to know that the consumer is not really located outside the US. And there's an exception for electronically supplied services, which you'll see crop up in a couple of different places here. So consumer electronically supplied service is deemed to reside at the location where the device used to receive the service is, based on IP address. But again, if that can't be determined based on reasonable efforts, again, billing address could be used as a substitute. And for this type of transaction, there's no special substantiation requirements. So toggling over to talk about general services that are provided to business recipients. Business recipient is really any recipient that's not a consumer. And a business recipient, the location of business recipient is a little bit more nuanced than with a consumer, because a business recipient is considered to be located outside the US to the extent that the service benefits the recipient's business operations outside the US. And The final regs tried to add a little bit of clarity there, or give people a little bit of a framework to manage with, by telling us that the recipient is treated as having business operations where it maintains an office or other fixed place of business generally, which is a term people recognize from the 864 regs, but again, the drafters of these rules have told us that it's not intended to be defined the same way. I believe perhaps to avoid pulling in interpretive authorities that they didn't want taxpayers to start pulling in. And if there isn't an identifiable office, you can use the business recipient's primary billing address. And the regs, in terms of, well, now I've thought about, I understand that I have to figure out which operations I've conferred benefit on. How do I do that? And the regs basically borrow 482-9, which contains the transfer pricing rules for controlled services transactions. And that sort of requires you to treat the service provider as a controlled taxpayer, and then treat the benefiting U.S. operations as one or more controlled taxpayers, and the recipients benefiting rest of world operations as one or more controlled taxpayers, using any reasonable method. So it could be on a per entity basis or a per country basis, and then to figure out under reasonable methods where the benefit has been conferred. And that might be based on the service provider's time spent or costs incurred with respect to each of these controlled taxpayers that you've created as part of this exercise, or it could be based on their sales, profits, assets, etc. My guess is that service providers will generally feel more comfortable with things like their own time spent or costs incurred, because they control that information, and a business recipient might not be willing to provide some of that other information that I referenced. A couple of exceptions to mention. Again, advertising services and electronically supplied services. So advertising services are, the benefit is deemed to be located where the advertisements are viewed. And in the case of advertising over the internet, that would be the location of the device on which the ad is accessed. Similar rule for electronically supplied services. They look at where your business recipients, employees, contractors, or other agents actually access the service. And if that can't be determined in the context of an electronically supplied service, and the gross receipts from all the services provided to that business recipient are less than $50,000 for the year, then you can use the recipient's billing address. If they're 50,000 or more, so if you hit that cliff, then all the benefit is deemed to be located entirely in the U.S., which is kind of a harsh rule, and it is a bit of a cliff, but that's the way that that's where they've chosen to draw the line. So this is a summary on slide 26 for reference of the substantiation requirements. I'm not going to speak about it in any detail. I'll say one more time, this is sort of the same paradigm that you've seen for substantiation in the context of sales of general property for resale or manufacturing, or sales or license of intangible property. On slides 27 through 29, I included 3 examples out of the regulations, and I won't go through these in detail, but the point that these examples really make is the impact of the special rules for electronically provided services, which obviously can change the result around location. And so you see that in examples 5 and 6. 5 deals with payroll services provided by DC to R, which the regulations conclude are electronically supplied services because the primary purpose of the service is to electronically pay R's employees, and they reach the result that you would think that they would reach. They look at where the employees access these services, where the devices are that access these employee accounts. And since 60% of them are outside the US, then 60% of DC's revenue from providing those payroll services is treated as foreign derived. Similar result for a web hosting service. That was, and I thought this example was actually helpful, where you're saying, look, DC is going to provide this service to R. It's a web hosting service. R provides consumer goods online. R's offices are all within the US, but it sells products to both US and non-US customers. And they first of all tell us that's an electronically supplied service. And secondly, R's operations are considered to be located for that purposes where the service is accessed. So where the website is accessed by its customers. So even though R's offices and R's operations are all in the US, you still wind up with this result that 30% of the revenue from providing that web hosting service under their facts is considered to be FDII services income. Good result. And then you can kind of juxtapose that against example 7, where you have a domestic court providing a consulting service, which is not an electronically supplied service. And it doesn't matter that that service is used by A to ultimately provide services to R. The location of the benefit is with A's operations in the US, and therefore it is not an FDII service in whole or in part. I don't want to take too much time on other services, but very briefly, proximate service is a service like other than a property or transportation service, if substantially all the service is performed in the physical presence of the recipient's employees, contractors, or agents, and that physical presence or that substantially all requirement is deemed to be satisfied if 80% of the service provider's time is spent on site with employees, contractors, and agents. Property service is a similar concept. It's service provided with respect to tangible properties located outside the U.S. If substantially all the service is performed at the location of the property, and the service results in physical manipulation of the property. So think again about the fabrication and installation of the turbine that I talked about a few minutes ago.
We gotta move on to Pauline.
Oh yeah. Well, let me. I think we've probably covered services enough. I'll say a word or two here on the related party transactions. Without going into a lot of detail, the concern with related party transactions is round tripping. They're concerned that without some safeguard, if you sell to a foreign related party, there's too much risk that foreign related party will turn around and resell to ultimate customers in the US. And the response from the regulations was to set up tracing rules to address that. And given the time, I won't go into too much detail, but these rules do the same thing that the earlier rules do. They split out and deal with sales and services separately, and the final rules do make are a lot more user-friendly in terms of resales of property or component sales of property. It used to be that the unrelated party sale that's connected to your related party sale would have to have actually happened in order to claim the benefit. And they were sort of telling people that, yeah, that may mean that you actually have to forego the benefit and then amend your return later when there's a resale. They've moved away from that to allow people to substantiate that based on contractual terms, past practices, et cetera. So that's very helpful. Services, I'm going to give sort of the short shrift to, so we can turn to Paulina, but they use the same 482-9 principles that we've talked about to sort of make a determination about whether services that you may provide to a foreign related party are considered to be substantially similar to services that your foreign related party may turn around and provide to a recipient. And if we wind up with extra time at the end and people are interested, I can loop back and talk more about the related party services, but I'm going to park it there for the moment so I can hand the mic over to Paulina.
Good, thank you.
Excellent. So I will start by, let me just move forward. So there's a little bit of a key there for everyone. I think all this terminology is probably quite familiar to everybody. But more importantly, I think what I'd like to do is walk down a little bit of a memory lane, and it'll become obvious why I'm doing it in a minute. So even though the topic is the GILTI high tax exception, but it comes from the fact that we've had a high tax exception for Subpart F for quite a while. Subpart F was enacted in '62, so some people probably weren't even alive then. And that high tax exception has existed in Section 954 and is elective. It still is, so that still exists. And then GILTI rules were enacted under TCJA in 17, and then in 19, the final and proposed regulations were issued, and high tax exception was in those proposed regulations. The final regs that came out just a few weeks ago in July adapted some of the provisions, but also made some substantial changes. So for those of you that follow this, as we go through the final regs, you will see that some things were pretty significantly changed from the proposed regs. At the same time, another set of regs was issued under Subpart F in proposed form, also relating to the high tax exception. And we'll talk about that fairly briefly at the end because they're still in proposed form. But essentially, these regulations are tying the Subpart F high tax exception into the rules that are currently in final form for GILTI. So let's talk about the original rule, Subpart F statutory high tax exception. So essentially, Subpart F rules were enacted in order to avoid, they were anti-deferral rules. So the idea was that if a controlled foreign corporation is operating in a high tax jurisdiction, there is no intent here to defer earnings and have them low taxed or no taxed. So the rules were provided to allow for someone to elect high tax exception and that therefore exclude that amount from Subpart F income. At the time, U.S. corporate rate was 35%. So finding jurisdictions that in fact were higher than that or higher than 90% of that amount was actually for quite a long time quite difficult. So, but it did become quite useful as soon as TCJA was enacted and the U.S. corporate rate was reduced to 21%. So in fact, after TCJA, there was some desire to do some tax planning to potentially fall into the Subpart F regime, be able to use the high tax exception, and avoid falling into GILTI. I'll go through the GILTI rules a little bit, and it'll maybe become more clear why that would have made sense. So let's talk about the GILTI rules generally, and we'll have a brief example as well for you to look at the calculation. First of all, guilty only applies where we have a CFC. So if we don't have a CFC, these rules are not relevant. We need to have, they apply to both corporate and non-corporate shareholders that hold 10% or more. They apply very differently to corporate and non-corporate shareholders, as you'll be able to see shortly. But guilty is actually the difference between net tested income and the net deemed tangible return, which is calculated below. So essentially, we start with computing CFC's taxable income. We remove subpart F because that's already taxed under the different regime. We reduce U.S. source income because obviously that would be taxed in the U.S. already, and also related party dividends. There are also a couple of other items that are not as often used, like oil and gas and so on, so I didn't include them here. Then the net deemed tangible return is computed as 10% of QBI, which Bill went over, and the rules are the same as they are in FDII, as they are here under GILTI. So we want super high QBI, and we want as little of net taxable income as possible, because essentially GILTI is the difference. And so if we increase the QBI, then our GILTI calculation goes down. What happens is it's done on a CFC by CFC basis, and then you net all of a shareholder nets their share of their net tested income, net tested losses, and then determines if they have a GILTI calculation. So let's take a look at a quick example here. U.S. company owns 100% of a foreign sub in country Z. The rate there is 28%. And taxable income is $320 million from manufacturing. We're going to just ignore subpart F, assume that this entity doesn't have subpart F income, just makes it simple. And $425 million of average tangible assets. So GILTI would be tested income, $320 million from manufacturing, that's a net number. QBI, 10% of the average tangible assets, we reduce. And that leaves us with GILTI of $277.5 million. Okay, and so now what happens? Well, if we have a corporate shareholder, then they would also get a 50% exclusion from that GILTI amount. They also would be able to claim a deemed paid credit for foreign taxes that's maxed out at 80%, but nevertheless, any excess foreign tax credits that haven't been used in the GILTI basket cannot be carried forward. So they are lost completely. For non-corporate shareholders, the result is quite different because they don't get a 50% exclusion. They don't get a deemed paid credit. And for that reason, one of the things that has been done quite a bit is consideration given to the 962 election, which allows an individual to be treated as if they are a corporation for this purpose, and for purposes of subpart F and for GILTI. And therefore, then they get the 50% exclusion. They do get deemed paid credits, but they will be taxed one more time when there's a repatriation. So we won't go through the 962 election that I'm sure has been covered in other topics, but it is something to keep in mind. Without it, the non-corporate shareholders are taxed very, very punitively. So let's talk about these regs particularly. They set out 5 specific steps on how to determine the high tax exception. So so let's go back to what I said originally. The subpart F high tax exception was actually pretty straightforward. It was a CFC by CFC analysis, and it was not that complicated to determine if you wanted to use it and make the election. Now, the GILTI high tax exception is now significantly more complex in terms of calculations, and Bill referred to the fact that we always advise to model. By the time I'm done, you're going to see why, without modeling, this is virtually impossible to make a decision if you want to claim the high tax exception or not. Because it isn't, it sounds like absolutely it would be helpful, but in some cases it actually produces a negative result. So the 5 steps are: we first identify CFC members of the same CFC group. So CFC group is now a defined term for this purpose. We also identify CFC's units, tested units, another defined term. We'll go through that in some examples for it. Then once we've done that, for each tested unit, we have to determine tentative gross tested income, allocate and apportion deductions, and for each tested income item, and then finally calculate the effective rate for each tested unit. So let's tackle item 1. So CFC group. CFC group is, they're using 1504 rules for an affiliated group, except they're slightly modified. First of all, under normal rules, you would not generally include a foreign corporation, but in this case, obviously we do. The ownership threshold is moved down from 80% to 50%, and it's vote or value. We also use the constructive ownership rules to determine, under 318, to determine whether this is in a CFC group. The timing of this is done at the close of CFC's year that falls within the year of controlling domestic shareholder. Controlling domestic shareholder, again, is a defined term. And that is U.S. shareholders that own directly or indirectly more than 50% of vote, not vote of value, just vote, and undertake to act on CFC's behalf. This will be important not just for CFC grouping rules, but it'll also be important as to who makes the election. So just keep that in mind as we go through it. There are also some tiebreaker rules if members of more than one group. What's interesting is that some comments indicated that these tiebreaker rules are insufficient to tiebreak everything. So let's talk about step number 2. So now, once we've determined the group, CFC group, we need to determine tested units. This is probably the most important, I think, one of the most important areas of these regs. So you can have 3 types of tested units. First of all, the CFC itself. Then interest in the pass-through entity. If that pass-through entity is either a tax resident of another foreign country, so a different country than the one that CFC is in, or it is not transparent under the foreign laws of the tested owner, the CFC. So if it's treated as a taxable entity in that country. And the third kind is a branch. But again, it's a branch of a CFC, but if it has a taxable presence in the country where the branch is located, or the owner's country excludes branch income. Okay, so there are, as you see, there's some, everything has an exception. So it's important to go through these rules, and we'll go through a couple of examples that'll help to see how these rules apply. If the CFC's tax residents of a single country, CFC tax residents of a single country are a single unit, right? So if the country is the same for the branch and the CFC, for example, they become a single unit, so they're combined. But that's not true if you have a non-taxable branch. We'll look at an example of that. Or if there's ownership by different CFCs, right? So you have, I did not put in an example, but there is an example in the regs that's really interesting where you have 2 different CFCs that own a partnership, and they have a certain percentage of the partnership and how the groupings are done. So let's have a look at the example. In this example, FBI is a branch. It shouldn't be a box, so apologies for that. It should be a branch. So you have a U.S. parent with a CFC that owns 3 things. It owns a CFC in country X, FDII, then it owns a CFC in country Y, 1Y, and it has a branch in country Y. Okay. In this case, one unit is country X unit, and this one's pretty straightforward. We include CFC 1X, which is a CFC itself, and its subsidiary in country Y. For in country X. Then for country Y group, which is unit 2, we combine the CFC. I just realized this should say, instead of FDI 1Y, it should say CFC 1Y. And then it includes the branch as well. So it's combining the two country-wide items. Same fact, except FBI branch is not taxed in country-wide. So let me go back for a second. So this branch, FBI branch, here it was assuming that it's taxable. But in this part of the example, it's not. So it's treated as a transparent interest. That's a defined term as well. Now the combination is different. We have the CFC itself, its subsidiary FDIX in country X, and the branch. Even though it's in country Y, it gets grouped here because it is a transparent interest. And then for unit 2, you just have one, and again, this should say country Y. Unit 2 would be country Y unit. Another example. This is interesting because here it deals with the FBI branch. It's not only is it not taxed in country Y, but country X, where the CFC is located, it doesn't. It's exempt there too. So now the branch is going to become its own tested unit. It's going to be separated. Okay, so then we have several groupings. We have the CFC itself, its subsidiary FDX, it's in country X unit. The branch is now on its own as a tested unit, and FDE 1Y is in country Y. So normally the country Y items would be combined, but this is one of the exceptions where they are separated. So why is this so incredibly important is because depending on the rates of tax, in the past, we maybe would have been combining the branch operation as well as the CFC operation, and they would have been high taxed overall. Now, with a carve-out, you could end up in a situation where the branch is going to be sitting on its own, and therefore your high tax exception may not be nearly as advantageous as it would have been in the past. So the next step is now we have to determine gross income in each tested unit. This is fairly straightforward, except for one thing that we're going to talk about in a minute, which is disregarded payments. But before that, you look at gross income that's attributable to the tested unit. You're using books and records for this purpose. If there are no books and records, you're supposed to pretend that there were books and records. So it's as if there would be books and records for that tested unit. You also separate passive income as well as general income into two different categories. And this is what I meant talking about the disregarded payments. There's an adjustment that's required where we would have payments that normally would be disregarded, and I'll look at the example next to this. But it needs to be that income where before we would just ignore it, like we had a check the box entity. Here we actually have to reallocate those amounts. They are regarded for this purpose because we're dealing with different tested units, and they want to get the actual gross income of each tested unit. So if there are disregarded entities involved, the payments between them need to be looked at. So let's look at an example of this. We have a CFC, and it has a subsidiary. Subsidiary is receiving service income, and it's making a $20 interest payment, which is deductible in countrywide. It's making it to the parent CFC. What would happen in this instance is that we start with local books and records. So local books and records is the CFC picks up the interest income amount of 20, and if the subsidiary would have had $100 of gross income, of service income that it received. So the adjusted amount is 100, and for CFC, it's 0. But we have to reallocate $20 from, we're taking it out of the FDI amount, the subsidiary, and we're putting it into the CFC1. So if the subsidiary here was a check-the-box entity, we would have ended up with all these amounts, the $20 being completely ignored. But here we can't ignore it. We're operating as if they're completely two separate entities, and we have to put that amount back on. So now we end up with $20 of gross income for the CFC, for the interest income it received, and $80 of gross income for the subsidiary, even if that subsidiary is checked entity. So that calculation will have to be done in order to determine gross income. That takes us to step number 4, which is where we do the deductions. The deductions are essentially following 861 regs to determine how the expenses are portioned and allocated for CFCs. And you have some interesting specific rules where the upper tier CFC may be treated as holding assets or earning income of a lower CFC under the modified gross income rules. Also, to the extent we have taxes that are imposed on disregarded payments, these are the amounts I just talked about, where you have reallocation of disregarded payments. Those taxes will be attributed to the payee unit because that's where the income is moving. So they're following, the tax kind of follows the income amount. And last but not least, there's a calculation of the effective tax rate, which is we just divide the US dollar amount of foreign taxes by dollar amount of tested income plus the tax amount, so to determine that ratio. Now, once the election is made, if we decide to make a high tax exception election under GILTI, the gross income, but also the related deductions are removed. So are the foreign taxes associated. So everything just kind of disappears, which means that these foreign taxes can no longer be claimed as a credit either. So that's another thing to pay attention to before that election's made. Let's talk about the specifics on making this election. So first of all, the election has to be made on a timely filed original return. It also can be made on an amended return, but there's some very specific rules related to amended returns, which I'll go through in a moment. The election is made by controlling domestic shareholder or shareholders. And if you recall in the beginning, I mentioned controlling domestic shareholders are those that own combine more than 50% of vote. If we don't end up having controlling domestic shareholders, meaning you don't have a group that owns more than 50% of vote, then the election has to be made by all the shareholders. If we do have a controlling domestic shareholders, the regulations require that there is a notice given to each non-controlling US shareholder, which makes a lot of sense because if they're making an election, or particularly if a return is being amended, they need to be notified so they can take action as well. What's interesting is that the preamble mentions that domestic partnerships can be controlling domestic shareholders, but it's not in the regs. What the preamble says is that that's their intention, but they plan to address it at some point later. It doesn't say when later, so we'll have to see how that goes. The election is binding on all CFC US shareholders, and as I mentioned above, it's an annual election, so that can be made 1 year and of course not in another year. So, but once made, all the CFC US shareholders have to abide by it. With respect to the amended return, it can be done, but there are some parameters. First of all, it has to be done within 24 months of the unextended original due date of the return of the controlling shareholders inclusion year. Also, all of the amended returns for the US shareholders have to be done within a 6 months period. It's interesting to determine what drove that, and the preamble to the regs addresses the fact that this was done for administrative purposes, for the government to be able to process refunds and review the returns to avoid having problems with the statute of limitations on the timing. Then the effective date, super important. This applies to tax years of foreign corporations on or after July 23rd, 20. So for calendar years would be 21, but it can be applied retroactively. The retroactive application requires consistent application. So, and there's a lot said about that in the regulations. The consistency requirement was very, the IRS was Treasury was super concerned about that. So because of that, going back, before making this election retroactively, there are a lot of things to think about. Application of NOL rules, tariff carryback. Also, to the extent, and I mentioned this here in the slides, that if a taxpayer was allocating deductions related to disqualified bases for Subpart F, it might cause actually increase in Subpart F income. So we have to, again, we have to model before making that decision, especially on retroactive applications. So different considerations, and this is not an exhaustive list by any stretch of the imagination. This is strictly just some things to think about. For U.S. corporate groups, we lose the ability, to the extent we take the high tax exception, we lose the ability to cross-credit foreign taxes and high and low tax liability. Also, this is sort of a hidden gem, but income that's excluded is not PTAP. It's not previously taxed ENP. So in order to not have taxation in the U.S., one must meet the 245A requirements, which have a holding period requirement to still be tax-free when there's a repatriation. So if shares were not in these test units were not held for long enough, then 245 may not apply, so that could be dangerous. Also, the dividends under 245A do not qualify for foreign tax credit, but the PTAP income, when there's withholding on distributions, may be eligible for foreign tax credit. So again, if it's coming out of a jurisdiction where there will be withholding tax, that needs to be considered. I mentioned previously anything to do with this for individuals and partnerships. And for individuals, we certainly need to think about the 962 election. And also, we need to think about the tangible income return on QBI because that amount is helpful to us of having, if there's a company that has very high QBI, if we are to take that out of the calculation, we can actually be losing the benefit. And the last area that I wanted to cover is the proposed regs that came out for the Subpart F high tax exception. So if nothing was done, the high tax exception for Subpart F would have been completely different than what has been now put in place for GILTI. Because as I mentioned, Subpart F high tax exception is a CFC by CFC calculation. So it is a very, very different calculation. But the government has made a decision that instead of having GILTI follow Subpart F, they made a decision that the Subpart F high tax exception has to follow the GILTI rules that have been finalized. So these proposed regulations attempt to tie Subpart F high tax exception to the GILTI rules. First of all, the election will be unified. So once made, it will apply to both Subpart F and GILTI together. We won't have separate rules. And the test unit method has been adopted for Subpart F. So would be adopted for Subpart F if these regulations are adopted and proposed as they are in proposed form right now. What's interesting is that they actually went ahead and made some changes to the final regs that they just issued for GILTI. Also, there are a couple of things that are different. So first of all, they created a separate category of gross income. Remember when we talked about gross income, there are two categories, as passive and general. They're now adding a category called equity gross item. Also, the books and records method would be replaced by applicable financial statements in the order of priority. So audited financial statements first, and so on, going down the line to the last being the management's books and records. There are a couple of anti-abuse rules that have been written in the proposed regulations. They also clarified that if the foreign tax rate ends up being negative or undetermined, so if you have a loss and you're dividing by 0, in that item to determine your effective rate, then the item just would be automatically deemed high tax. That was not clear in the final regulations. There are also documentation requirements for taking the high tax exception. So the taxpayer actually has to go through and have all these calculations prepared, so no back of the envelope analysis. They don't have to be filed, but they do have to be maintained, and show how these high tax exception calculations were done. I think that covers everything that I had to go through, and I'll turn it back over to Bill.
Thank you, Pauline. We have some questions here. Let's see what. Read them. This is, he's asking me, I guess, can you state a fact pattern and apply the rules? The narrative is a bit hard to follow. Yeah, I'm sorry, I get lost in the using a different computer. He's asking about the FDII deduction, and maybe just to bring it back here. Oh, thank you. The FDII deduction is only available with respect to a C corporation. So if you're not in the C corporation land, you can't use it. It's got to be a domestic C corporation. I mean, there's some exclusions from that, but mutual funds and so on, but let's don't get into that. So that's generally what it is. And then to have a qualified transaction, you need to take care of the things that Brian was talking about. That is to have this foreign derived deduction eligible income. And this so happens the way the formula works together, it's you first start off with kind of domestic operating income, if you will, and then you multiply it, because of my slide 16, you multiply it times a fraction, the numerator of which is the material and transactions that Brian was talking about. So you want that number to be as high as possible. So if it's all of your operating income, then you're going to have a fraction that's 1. And you just multiply it through. And then that just gives you the base. Against that, you then apply the deduction amount, which is this 37.5% for FDII. Unfortunately, that deduction, the FDII deduction, the FDII deduction, and the GILTI deduction at the C corporation level, has to be within the taxable income of the C corporation itself. So you have these two bases. One, you have 50% of GILTI, and the other 37.5% of FDII FDII. And the FDII and the GILTI, not the amount after you complete the deduction, but the base of those two deductions must be less than taxable income. If it exceeds that, then you have to reduce both of them. And then you have some more complication, which is in my example, and the regs largely punted on. What do you do if you have multiple interrelated deductions? 163J, which is your business interest deduction, which is your 30 or 50% now for a couple of years under CARES. What do you do with your NOL? And then what about the 250 deduction itself? Is it kind of circular? Is it simultaneous equations? How do you do that calculation? Under the proposed regulations, they had an ordering rule, which is described in one of my slides. But the final regulations for FDII said any reasonable method, which includes simultaneous equations, which seems a little difficult because you have at least 3 simultaneous equations, which you got to solve by a matrix or some kind of elimination. And plus the variables are a little strange because each taxable income limitation, so to speak, is slightly different. So I've tried to do that. You can do it, but it's a little more difficult. So that's the best I can do for a fact pattern. So it's basically going to be an exporter of goods, services that meet the requirements that Brian's talked about. And is the system, this is another question from Sanford, is this system the taxpayer opts into, or is it mandatory? In other words, you have to take the deduction. if you have a qualified transaction. Good question. You can't in the substantiation requirements throw out losses, but I think it's part of the calculation. If you're a C corporation, you have guilty in these transactions. I don't think you can elect not to do it. I mean, can you waive a deduction? I guess is what he's asking. And I don't know what you might want to do that because of some beat considerations or something like that. But it seems to be something you're required to do, in my view of it. And I think that's it. Was there any other? I didn't see any other questions on the chat box. Pauline, you want to talk a little bit about how this FDII deduction and GILTI work together, and whether there's any planning and kind of reshuffling or restructuring to take care of one or the other?
No, you can go ahead if you want to.
Sorry, what?
No, go ahead. Yeah, no, not me.
Yeah, I mean, there was the question about, do you want to move the whole idea of the Tax Cuts and Jobs Act was to encourage domestic activity. And it was not to have intangibles overseas and not to have manufacturing overseas. So the question is, in real life, is there this kind of incentive in the actual statute in practice? If you have your manufacturing overseas, then as some of these examples show, you're talking about a 10.5% rate, which is actually slightly higher because of if you have foreign taxes, because there's only an 80% deduction. Also slightly higher than 10, it could be more than 10 because of the foreign tax rate itself. But assuming you got a low foreign tax rate, then GILTI would give you this 10.5 at the C corporation level. Individual, we can push this aside for a moment. So then if you did the FDII deduction, if you could do the same activity, which is what my illustrations in here are trying to do, using the same fact pattern and doing it under all these different rubrics, if you will, then you're into 13.125% effective rate, which sounds worse than 10.5, but the 10.5 is really, if you got any foreign taxes, it's not really 10.5. It's going to be a higher number because you're losing foreign tax credit.
Yeah, they were envisioned to be equivalent, right? That they would both get you to 13.125 in most situations, probably.
Very often, unless you got a very high foreign tax rate, then you wouldn't want to do it overseas, at least from a tax point. You bring it home because you've got a 21%, which if it's export, you can drive down.
Yeah, I mean, the whole idea was to take the tax out of it, that people would make business decisions about whether to keep these functions in the U.S. or put them someplace else. And when the proposed regs came out, the practical aspect of it was, I think people reacted to say, well, this is the way the rules are going to work. If this is what we actually have to do to be able to claim the deduction, then it probably makes more sense for us to just put our operations overseas and claim a GILTI deduction. And that's, I hear where people are coming from on that, but the practical question that you have to answer taxpayer by taxpayer is, well, what do people actually have? Because if all your functionality is really in the U.S., are you really gonna? There are significant non-tax costs associated with just deciding, well, now I'm going to have a hub in the Netherlands and I'm going to start putting spokes in all these different places. It's not really a tax question anymore, and so
you can't really move assets or intangibles overseas without having a tax cost. The intangible trigger 367D, which would be a kind of a deemed royalty, if you will, or that you pick up as a royalty, so you don't get away from a tax-free movement overseas. If it's other assets, it's going to be, if there's any gain, it's going to be picked up as well.
Same way as you can't give out as a tax advice of, well, in order to get a better QBI, why don't you just move your tangible assets outside of the United States? That's not a practical consideration, because even though it works out on paper, but as you said, Brian, it's pretty expensive to make that happen.
Yeah. I think it's kind of strange because if you might be in your business assets, so to speak. When you're overseas, you want QBI to be big, because whatever, at least you're a C corporation, because whatever you're sheltering from GILTI is going to come out as a tax, presumably a tax-free dividend or a dividend received deduction with respect to that dividend. But domestically, you want your QBI small because you want to build up the base against which you apply the deduction. So it's you go low domestically and you go high foreign. So,
yes, yeah. Put all your tangible assets someplace else and keep all your IP here.
yeah. So anyway, that's aspect of it. The 199 I just threw in there because you may a lot of people have, you're working through domestic pass-throughs, or I guess some people could even have their own proprietorship, so to speak, that are overseas. And there, we're not able to cover it. We did cover it a little bit in our prior webinar on this topic, but in the subsequent one we'll cover it. But the question is, if you got an individual that owns a controlled foreign corporation, and that's, you're doing that for tax purposes, you're not going to get the 10%, 10.5% effective rate if you actually distribute the earnings. You're going to get the 10.5% initially on the inclusion, but when you have the dividend, it's going to come out at, depending on whether you got a treaty protected CFC. If you got a treaty protected CFC, you'll get the qualified dividend rate of 20.3.8. If you don't, you're going to have up to 37% tax rate. So you can work through it. It's again in one of these examples. So then you may be better with what, 199 deduction in a pass-through, and you're going to get, assuming tax business considerations aside, you'll get what, a 29.6% final rate, as opposed to this 37 plus 10.5 if you do it through a CFC. So the accountants are right. You got a model. Lawyers are right too. It depends, but at least the accountants are getting you further along. What you actually have to do, which is to do the calculations with your facts.
Yeah. Now even the lawyers do modeling now.
Oh, okay.
Scary thought. On that note, I think we're out of time, guys.
Taught by the accountants. They're going to keep saying it, so we're going to finally do it when we hear the word. Anyway, the calculations are important, and because of the state tax is another issue that comes, state income tax, you know, how that operates, that changes the results. NOLs distort things. The business interest deduction is a distorting factor, especially if it's under limitation. And what's the other? Well, I guess that goes to those, the two big ones I see. There could be other ones as well. So you have to use your actual facts and work it out. But the basic picture that I drew, which is 10.5 GILTI, 13 1/8 FDII, and 29.6. I think we call that deduction. The 20% business income deduction. That's the kind of baseline, but the real facts change those relative positions and change the relative tax burdens considerably. See anything else?
I think we're out of time.
We're out of time besides.
Looks that way.
I think so.
All right. Well, thank you all, and thank you for listening. Sorry about the technical problem at the beginning. Used to another computer, but we got through it. And my panelists carried the ball home here. Thank you very much.
Bye, everyone.
Bye.
Thanks all.